Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Great. We'll do Exhibit C first. I'm not inclined to change any of the supply or demand numbers on Exhibit C because the oil market's really relaxed. The oil price is definitely trending down. There's no question that 20 million barrels came through Hormuz before February. At least 10, maybe 11 or 12 on average is coming through. These are tankers with their GPS indications turned off, and the industry is continuing to function and make sure that oil doesn't go to $100 or $120 or $140. So it's not a matter of negotiations between Iran and the U.S. It's just people have worked out how to keep the oil moving. It's much harder to move products. And in fact, the product markets, in other words, gasoline, diesel, jet fuel, are trading at very high spreads over crude. And that's because it's harder to move those products through Hormuz as compared to moving crude. Also, in Russia, Ukraine's been very successful at putting drones into Russian refineries. And so Russia has curtailed exports of products. Normally there'd be oil and jet fuel coming out of Russia, but there's not. But that being said, of course, in the U.S. political situation, we're wondering what this means for gasoline prices going into the midterms. I think average gasoline prices are around $4. I suspect by the time we get to the mid or late September, it'll be $3.50. So things will start to look more normal in the energy markets. On page 2, where we have the prices from last Thursday, the near-month price was 87. It's now down, but the interesting thing is that the 27 price just doesn't move too much. So this Thursday, that near-month price will probably be 81 or 2, and the 27 price, rather than 75, will be 73 or 74. And I think the reason for the big gap between the near-month price and the average 27 price is the possibility that things get even more normalized. And so, as I've said on prior Wednesdays, companies making decisions about whether to drill complete wells are looking at 70 or 70, somewhere in the 70, 75 range. And I believe investors in companies like EOG and Magnolia, and the companies are outlined in our page with crude oil producers, investors are also looking at it as oil being a $70 to $75 price. The gas price has kind of stopped going down. The 27 price is $3.30. The near month is $2.76. The production demand numbers have been changed. What's happened is production is running higher than it was before. So this estimated 26 dry gas production, 109.5, and 27, 111.5. I moved those up last weekend. That's mostly coming from the Permian. You look at the chart above, it reads not just 21 to 25. It used to be, now it's 21 to 26. You can see of the increased production of 18 million Bs a day. Of the 18 comes from the Permian. The Permian price, the Waha price, is trading at a discount, trading at below zero for quite a part of the year. But a couple of pipelines have come up, and that's now trading at, there's one, the Henry Hub is 270. But what has happened is people had shut in wells just because they didn't want to give gas away. And that's caused at least a day of increased production. And I think it's reasonable to expect that to consider in 27. If you go down the demand numbers, we started We had regular increases in demand for gas to make power for about 1.5 Bs a day. And that flattened out in 25. Actually, 25 was down for 24. 26 is starting to look up a little bit, and I think 27 will look up. The demand to make LNG, look at 24, was flat, but now it's 16 and 25, 18 this year so far, and I think 20 and a half is a good number for next year. So demand is increasing. The storage change, which was as high as 3.4 in 23, and you can see what happens. The gas price comes from $6 off to $2.75 on average. That has remained higher than would be ideal. The numbers turned out last weekend, have that down to a B. I think if the difference between supply and demand is as low as a B, I think that 350 forecast for 27 will come out pretty well. Exhibit A, this is a darn good chart. If you show it to friends or colleagues, it's going to be very useful to try to understand the debate over our national debt and what to do about it. They have an estimate here for 26, deficit of 1.55 trillion. It will be higher than that. It was 1.9 next year. I'd been hoping that it dropped by about 400 billion. I'm not sure that's going to happen. And I'm not sure the forecast for 27 at 1.5 is going to happen. I think our Treasury Secretary, Scott Bessent, had a press conference on Monday on the Iran situation. He did a pretty good job. I think one of these weeks, probably on a Monday during trading hours, he's going to have a press conference laying out an estimate for the federal government that the Trump administration favors that will take the deficit from where it is now down to a lower number. There was an op-ed by Stanley Druckenmiller in the Wall Street Journal this week. Recommend that everyone listening reads the op-ed. He has an important role because both Scott Bessent, the Treasury Secretary, and Kevin Warsh, the new Fed chair, are proteges of Stanley Druckenmiller. And basically what he was saying is the 10-year bond, which is the most important rate or the most influential rate in the world economy, the 10-year U.S. Treasury, keeps creeping up. And Druckenmiller's point was, listen to what it's saying, which is these are not sustainable. And it's not just in the U.S. The same thing has happened in the market for Japanese government securities. Japan has run a deficit, and their debt as a percentage of GNP, we're hovering around 100%. Theirs, I think, is around 150%. So this is something that has to be addressed by governments worldwide. If you look at the columns, the only way to really make a significant dent, you can't do too much about the interest. The interest, if you go all the way back to 2018 or 19, was like 400 billion, and now it's $1 trillion. That's an average interest rate of 3.5%. The Fed funds rate may come down a little, but it's not going to come down very much, I don't think, for a while we're running inflation over the 2% target. And then the 10-year bond is trading at 460 or 470 or something. So we're stuck with 3.5. That'll likely move up a little bit. And we're stuck with the amount of debt because each year we add more debt as we run these deficits. Defense has been right in around the $1 trillion range. It is going to go up. All other, which before the pandemic was 900 billion, is coming down to $1.1 trillion. That wouldn't be bad. So you got to go. Social Security is pretty well set by the number of people turning age where you get Social Security payments. So you have to go to work on Medicare and Medicaid. And I know I sound like a broken record, but it seems to me that if we had a recurrence, the situation we had in '08, where it was brought on by excessive speculation, basically, in mortgage bonds and real fear in the capital markets, if something like that recurred and we had a bipartisan effort in Congress It just seems to me that the logical thing would be to extend Medicare to everyone, no matter what their age is, and basically phase out Medicaid, which is a program run by the states that the federal government contributes half of. So for 27, with the federal government contributing $600 billion, that would be a total of $1 trillion too. Well, do the states really need a Medicaid program if everyone living in the state qualifies for Medicare? Now, what we would do in that situation is what we do with people in the Medicare program now. If you want to buy additional insurance or if you get additional coverage from their employer, that's fine. But it's just there's a minimum amount. Everyone is covered, at least. So there's no one uninsured in our economy. Now, if you try to sell that to a conservative politician or public figure, you make practically no progress at all. And in fact, two colleagues doing these podcasts, Mike and Jason, I probably can't talk them into it. But we need to deal with this deficit. Druckenmiller's essay and op-ed piece is excellent. I just don't see how else to do it. With that, I turn it over to Mike and Jason to disown the idea of Social Security for everyone.
Well, here's how I think how you sell it. People on the right side, the Republicans, don't want all the fraud and waste going on. And it does seem like there's more abuse in the Medicaid system than Medicare. So maybe you can convince them that it'll lower the rates of abuse of that system if it's all under one organized by CMS rather than individual states.
Well, the second thing that would be so you could get the conservatives on board with is to eliminate the rules that have been set through the Affordable Care Act that require insurers to basically take anyone. So allow them to go back to excluding patients that they would otherwise not want to insure at any price. So in that manner, you could create a more market-based system. You would still have a catch-all for everybody within Medicare and eliminate Medicaid at the same time.
And then there's 51 overlapping layers of management between all the states and then the federal government.
Yeah. Yeah. Unfortunately, I hate to say that the solution to this problem is a government-run program, but it does seem like the incentive structure that we have set up is so poor that if it's not fraud, it's just the structure is set up to basically charge more so that everybody makes more money.
Yeah. Last week, we did quite a lot on Moderna and cancer vaccines, and we said we were short time. We promised to get back to it. Jason, any additional comments in the succeeding days? Just the comment I have is it is promising and a huge advance, but it's still going to take quite a lot of time before it makes a significant dent in our fellow citizens that have cancer.
Yeah, it proves the science. So now we know it's going to work for some set of cancers, and hopefully it's a very large set. It does not prove that it works for all of them, and frankly, it just won't. And there's just no way around. We're going to have to run these same level of studies for every type of cancer. So you're right. It's going to take quite a while before this becomes the standard that everyone has.
I would also say that we're missing some very important data from that trial as well. Like, people are very excited about it, but they didn't publish a hazard ratio or a p-value. So we don't know a lot of things about it yet. Everybody's assuming that it's going to be as good as or better than the phase 2, which would be wonderful if it was, but we won't know until they publish that data.
All they said was they met their endpoints. So the trial was a success. They had a statistically significant reduction in reoccurrence. But yeah, we don't know if it was better or worse than phase 2. One thing that's really interesting is the economics. I don't think we got into this last week. Is Merck actually co-developed the vaccine with Moderna. They cut that deal before COVID. So at that point, Moderna was cash strapped. And the result of that deal is they shared 50-50 the study expenses, the research and development, and Merck will get 50% of the profits. But this is a combination therapy with Keytruda, and they get 100% of that profits. These drugs probably won't be the same price, but if they were, that means Merck gets 75% of the profit out of it.
Yeah. Keytruda is about to run off patent, isn't it, Jason?
It is, I believe, early in 28, sometime in 2028. Yeah.
It's soon. Now they have a successor product that is it's a subcutaneous delivery rather than an IV delivery.
Yeah.
Which they will try and currently have ongoing programs with Moderna, where the combination therapy is with the subcutaneous version, obviously with the purpose of pairing those two together. So Merck has a big hole to fill with Keytruda, but a lot of the work they're doing is trying to ensure that this new product gets adopted.
The thing I'd like to switch to now, Jason, that Mike and I were talking about this morning is, I guess I'm going to say something I'll probably regret, but I don't see how an investor can not own SpaceX. And I just want to tick off some reasons why. One, there is this huge gap, which we've discussed on prior Wednesdays, between compute demand and compute supply. And in every state, not just the Northeast, but also Texas, governors are taking positions that will substantially slow down building more centers. That makes SpaceX's commitment to try to do compute and satellites much more compelling, I think. If you look at chips in general, or the servers that go into data centers, one of the points that everyone's dependent on is Taiwan Semiconductor, and probably has all lithology equipment. SpaceX and Tesla together are planning to spend a lot of money, and they're actually under construction now to build a capacity to turn out chips without needing the SML machines, and in a process that might turn out to be more effective than what all the TSMC capacity is built on. Anyone delivering data, whether you're a phone company or a cable company or wherever you are, has to be concerned about competition from SpaceX's communication satellites. They have 12 million customers now, and it is expensive relative to current revenues or current cash flow or whatnot. But given, if we review the first 3 or 4 pages of the memo, and mostly technology companies, I don't see that you want to go through the next 5 years not owning SpaceX. Now, I know I'll regret saying this, or I'll catch some commentary from friends and family saying, you're falling for these dreams that Musk spins out. But having taken that position, can turn over to Mike and Jason for commentary.
Well, some of the best engineers in the world work for SpaceX and Tesla. They are very good at solving very hard problems. It is very difficult from a valuation perspective to get comfortable with a very large margin of safety when investing in SpaceX, at least using traditional methods. You have to basically give them credit for something that has not been done yet. Yet their execution has been so good, it's hard to disagree with it. On the first point about compute demand, we're seeing a lot of data centers get slowed down. And yet with SpaceX, they seem to be able to put compute online faster than anybody else by at least a factor of 2.
And not even in space yet.
And the more everybody else gets slowed down, the faster, or the more valuable the compute that they put together is. We looked at the company and underwrote it only on that ability to deploy terrestrial data centers. But then you also have the rest of the option value. You you have this concept of being able to launch space-based data centers, which on the surface may sound crazy, but we have spent quite a bit of time trying to understand both the economic and the physical limitations that make it whether or not this is possible at all. And the long and the short of it is that all these things are mostly possible. And if SpaceX reaches their target on cost to launch mass into space-based data centers, won't just be on par with stuff on land, they will become much cheaper than launching data centers on land. And that has to do with a couple of different curves, one being the launch cycle, right? Reusing the rockets and putting them up in space, but also the factory-like manufacturing of these data server racks and sending them up into orbit. It's not to discount how difficult this actually is, but again, you're talking about the team of people that has consistently proven everybody wrong that these hard things can even be done. So then it goes back to the question, what's your margin of safety? And at what point do you buy? And I think we discussed a few weeks ago when it touched around $100 a share, we said maybe on the high end it would be 80. And our history with Musk-run companies is that it never really gets to that number that you'd like it to get to. It may be a situation where you need to buy some and hold your nose. And with that in mind, you need to buy a size that is small enough that maybe it's not going to put your whole portfolio into a tough situation. Would you agree with that, Jason?
It's the scenario's easily there where this is the most important company in the world or in the US without taking a big leap of faith. I'll just make a point that I think most Americans don't realize this is SpaceX has already saved America's butt once. Prior to SpaceX, we used United Launch Alliance to launch all of our payloads into orbit, and they relied on Russian rockets. And if SpaceX wasn't able to do what they've done to date, and we were still relying on ULA, Russia would have cut us off from using their rockets, and we would have no path to put any payloads into orbit right now. So I don't think that little history is not realized by most people, but.
So is that worth 1 year's interest on U.S. government debt? That's about where the valuation sits.
That's very well about where SpaceX is priced.
Yeah.
The other thing, Jason, is that you know much better than Mike or I do, but what are his chances of becoming a significant source of chips at this 100 million square foot facility? He's got it permitted. I think they're starting construction in Texas.
Yeah.
How would you rate his chances you talk about hard things to do? My goodness.
They like to stack up a lot of hard things to do all on top of each other. And they never get them done on the timeline that they lay out, but they typically do finish the project.
Yeah.
So I think at some point it becomes a reality, but I don't even remember the timeline they laid out, but I don't think they'll meet it.
Yeah. Yeah. And for people on the phone or ourselves who are Tesla stockholders, count on it. By this time next year, you're going to be a SpaceX stockholder. There's no question that Tesla and SpaceX will be merged.
Right. They're divesting their Chinese business right now. So you'd have to imagine that's the reason they're doing it.
Now, for NVIDIA stockholders, it's interesting. The Musk entities complete to NVIDIA equipment. That's what they put in Memphis. And Memphis is very impressive because they were able to put in about 1.5 gigawatts of capacity for $28 billion. That's way under what people's rule of thumb is. And it's all NVIDIA equipment. And it's been leased on a basis where they pay out the $28 billion in about 18 months, 2/3 to Anthropic. Mike and I were talking this morning, Jason, 1/3 to Google. Why is Google put in a position where they have to go lease this NVIDIA capacity when they've built so much of their expectation around having their own chips?
Well, this is speculation, but I would say they've seen a huge influx of customers to their cloud computing platform. So those customers will come in and they'll probably want to be building their models and training their models on NVIDIA hardware, since that's what's portable between all the clouds. It's what a lot of the engineers are used to programming against CUDA. And well, a lot of companies don't want the lock-in of saying we're going to design our AI models to only function on Google TPUs. So I think it's to serve external customers, and that's probably fine for Google because they will keep their TPU capacity for themselves and their own services that they package up and they can sell as like a Gemini service.
My view is a little different. So Jason, we'll try this on you. They've had a lot of talent exodus, and there has been some stuff that's leaked out about how there has not been enough compute for the researchers. My suspicion was that potentially they're buying this for internal workloads, and that would jive mainly because it is a very large coherent cluster, which isn't really, it's going to be the most performant for doing research.
That's a possibility. The Google researchers have fought for extra capacity for over a decade now. So if that's still a battle going on, I guess that's surprising to me, but
yeah,
it could be.
The official statement from Google is that it's bridge capacity. So we'll find out how long that bridge is.
Next week, unless something else there is some breaking news, and Meta has this litigation going on where every state attorney general is suing it. And there was some speculation that the judgment that they're looking for is $200 billion or something like that, way more than just an impossibly large number. But I think there's some speculation that the 49 states attorney general and Meta are agreeing on something like 18 billion, and somehow it's going to be shared with YouTube and TikTok, so that only 70% of it may be paid by Meta. I know Mike and Jason are ultimately intrigued by Meta, but for someone thinking, holding an investment in Meta or possibly starting one, this has to be good news to remove this as a risk.
Well, it doesn't just remove it as a risk. It's also a little bit of regulatory capture in the process. Jason, you did some research on the rules that are going to be implemented, right?
Right. The rules that they've apparently agreed to are, let me find the set of them. It's a limit for children's use of the apps to no more than 2 hours per day.
A lot of time.
It's still a lot of time. A block they cannot use it between the hours of 12 a.m., midnight till 6 a.m. And they're going to take away the ability for any of these settings, which I find fascinating that they were, but for the children themselves to adjust these settings, that only a parent account for the child account can then adjust these settings. And then another one that's been rumored is that you can turn off the algorithmic targeting of content to a child's account, which that'd be fascinating because it takes social media back to how it started, is you just see the content from people you actually know in real life.
Right. But
yeah.
What's really happening here is they're going to implement a bunch of this stuff. And it's going to cost some engineering hours. It's going to make it a little harder for any upcoming social media network to be able to do stuff.
Yeah.
But the reality of what's going to happen is that all the children are going to register their accounts with the birth date that puts them above 18. And
which is what got Meta into trouble in the first place. And then this is reliant on all of the other social media apps having to follow these same rules, which isn't clear yet. And can you use 2 hours a day of each app? So if you just look at Facebook and Instagram, you're already at 4 hours. And I think the average teenager is on social media for 4 hours a day.
Okay, so that's an interesting bull case for Snapchat or something, right?
Yeah, and I thought they're going to turn it off during the school day as well.
I did see something about that, but I didn't see that was actually part of what they agreed to. Yeah.
Agents are much in the news. The latest Croc product, if you pay enough per month, you get agents off the shelf. So there'll be more news between now and 7 days from now. But I think you can expect that next week we will talk about agents, especially since Mike and Jason have several agents themselves and other people have agents. And it appears to be the case that this will do a couple of things. It'll probably be competition for the apps. Anthropic, I'm Claude, it'll probably also increase the demand for compute time, and it'll be either a plus or a challenge for Microsoft and Copilot. I think unless something else comes up, then we'll probably devote the middle part of our podcast to agents next week. In the meantime, we're a full 5 minutes over, so everyone be well and stay healthy, and we'll be here exactly 7 days from now. Thanks very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. Thank you for joining us this week. Please tune in again next week as we will be back on Wednesday. As a reminder, nothing on this podcast should be considered investment advice. You should always do your own work to determine if an investment is suitable for you.